Welcome to today's video, and today I'm going to be looking into the really interesting anomalies that are occurring in the oil price market at the moment. And Goldman Sachs has now joined a long list of other investment banks that have cut their oil price projections amid the ongoing oil supply glut combined with the slowdown in China's economy. Bearing in mind that over years gone past, when the China economy was expanding rapidly and booming, China had an immense demand for oil, and as a result, oil production levels increased to be able to meet this demand coming from China. But now that China's economy has slowed down drastically, so as well has been the slowdown in the demand for oil. And the situation has become even more dire now lately after Saudi Arabia rejected OPEC's idea of cutting oil production for cutting their oil production. For 2016, for instance, Goldman Sachs has revised their oil price projections from $57 a barrel down to $45 a barrel for US crude, and from $62 a barrel down to $49.50 for Brent crude. Now, it's in a research note entitled "Lower for Even Longer," the Goldman Sachs analysts said the following: that the oil market is even more oversupplied than we expected, and we forecast this surplus to persist through 2016. This oversupply could lead to oil prices dropping down to as low as $20 a barrel. Although this might not be the base level that it goes to. So, which means that already on September 11, 2015, the oil prices slipped by a further 2%. And due to overproduction and current crude oil stockpiles at an all-time high, oil prices have nosedived over the last year from $120 a barrel down to $40. And as a result, oil storage tanks capacity utilization has almost reached 100%. So in other words, across the world, we are getting really, really close to a situation where the countries of the world will not be able to store the excess oil that has been produced since China's economic slowdown. And the US government's environmental impact assessment shows that America's crude oil inventories have increased by 2.6 million barrels to the 458 million barrels in stock that it has stockpiled as of last week, and which is way exceeding the analysts' previous expectations of only 933,000 barrels. So in other words, the analysts expected a surplus of under a million barrels, not so much a surplus, but a stockpile of under a million barrels. Sorry, not the Environmental Protection Agency, the Environmental Energy Agency said that normal stockpiles are just under a million barrels, and currently there are 458 million barrels of stockpiled oil, which is and a further collapse in the oil price is going to be closing down the high-cost production from Eagle Ford in Texas to Russia and the North Sea. So in other words, should the oil price continue to be tanking as it is, there is no ways that the US-based fuel production companies will be able to maintain any sort of decent profit margins on such incredibly low priced and cheap oil. Because bearing in mind that they've been stockpiling their oil at higher prices than what is currently available directly from Russia and the North Sea at the moment. So that's my take on the matter. And as far as why Goldman Sachs is predicting the oil price can tank down to as low as $20 a barrel, simply because the amount of stockpiled oil is way exceeding normal standards and way exceeding what investors had previously envisioned. That's my take on the matter. Share any comments, criticisms and questions that you may have down below. Don't forget to click the thumbs up, like button if you like this type of content, thumbs down if not, that way I know what to be putting out in the future. And last but by no means least, there's a big red subscribe button below the screen as well. Hit that subscribe button, that way you stay subscribed to my channel for all the new content that comes out on a day-to-day, week-to-week basis. Stay safe out there. I'll be seeing you next time. Cheers.